In financial economics, money market and capital market are often confused. Technically, the money market refers specifically to short-term debt, less than a year, while the capital market refers to long-term debt and equity. Below is a detailed discussion of these various financial markets, their features, and examples. 1. The money market, short-term. The money market is the wholesale pillar of the financial system, used by banks and corporations to manage immediate liquidity. Feature: high liquidity, very low risk, and short maturities, overnight to 1 year. Example: Treasury bills, T-bills. These are short-term debts issued by the government. If the government needs cash for 90 days, it issues a T-bill at a discount, and investors earn the difference. Other instruments: certificates of deposit, CDs, commercial paper, and repurchase agreements, repos. 2. The stock market, equity market. This is where ownership in corporations is traded. Feature: no maturity date. It represents residual ownership, meaning stockholders are paid after all creditors. It offers higher potential returns but comes with higher risk, volatility. Example: common stock. Buying shares of a company like Apple or Reliance Industries. Primary versus secondary. The primary market is where a company first issues shares, IPO. The secondary market is where investors trade those shares with each other, like on the NYSE or BSE. 3. The bond market, debt market. The bond market is where organizations go to borrow large sums of money for long periods. Feature: fixed income. The borrower pays a fixed interest rate, coupon, and returns the principal at a set maturity date. Bonds are generally safer than stocks but riskier than money market instruments. Example: corporate bonds. A company like Ford might issue a 10-year bond to build a new factory. Measurement: bond prices have an inverse relationship with interest rates. As rates go up, bond prices go down. 4. Mutual funds. A mutual fund is not a market in the physical sense, but a financial vehicle that pools money from many investors to buy a diversified portfolio of stocks, bonds, or other securities. Feature: diversification and professional management. It allows a small investor to own a tiny piece of hundreds of different companies, reducing unsystematic risk. Example: index funds. A fund that automatically buys every stock in the S&P 500 or the Sensex. 5. Over-the-counter, OTC, market. The OTC market is a decentralized market where participants trade stocks, commodities, currencies, or other instruments directly between two parties without a central exchange, like the NYSE. Feature: less transparency and higher counterparty risk, the risk that the other person won't pay. It is often used for smaller companies that don't meet exchange listing requirements or for complex derivatives. Example: Forex, foreign exchange. When you swap dollars for euros at a bank, you are participating in the OTC market. 6. The derivatives market. This market deals in financial instruments whose value is derived from an underlying asset, like a stock, bond, or commodity. Feature: high leverage and used primarily for hedging, reducing risk, or speculation, taking risk for profit. Example: futures and options. A farmer might sell a wheat future to lock in a price for their crop before it is even harvested, protecting them against a price drop. Summary comparison table. Market type. Maturity. Risk level. Primary instrument. Money market less than 1 year. Law. T-bills, commercial paper. Stock market. Perpetual. High. Common, preferred stock. Bond market 1 to 30 years. Moderate. Government, corporate bonds. OTC market. Varies. High. Currencies, small cap stocks. Mutual funds. Varies. Diversified. Pooled portfolios. Which market is right for an investor? It depends on the time horizon. Need cash in 3 months? Use the money market. Saving for retirement in 30 years? The stock market, equity, is historically more effective. Would you like me to explain how interest rates determined by the central bank, like the Fed or RBI, influence all of these markets simultaneously?